Welcome to U.S. Tax Classroom. You know the traditional IRA deduction is absolutely one of the most powerful above-the-line deductions available to taxpayers today. Let me explain why this specific type of deduction is so incredibly valuable for us. It reduces your income before any of your other deductions are even calculated. That means it directly lowers your adjusted gross income right off the top. It powerfully reduces your taxable income today while simultaneously building your retirement savings for the future. That is a massive double benefit coming from just a single contribution. But there's a catch, and it trips up a lot of people every single year. Not every traditional IRA contribution is fully deductible. Whether you can actually deduct the full amount depends on a whole mix of things, like your income, your filing status, and, crucially, whether a workplace retirement plan is available to you. In this explainer, we are going to break down exactly how the traditional IRA deduction works for 2025. We'll quickly look at the IRA basics and deduction rules, the 2025 deduction phase-out ranges, how to go about calculating your partial deduction, situations when income does not matter, the highly complex spousal coverage situation, and finally, important IRA contribution deadlines. Understanding the difference between just throwing money into an account and actually being allowed to deduct it will absolutely determine your final tax outcome. So let's jump right into Section 1, IRA Basics and Deduction Rules. These are the foundational concepts. Before we get into any of the complex calculations or phase-outs, we absolutely must understand the core concepts of how this works. A traditional individual retirement arrangement allows your invested money to grow tax-deferred. This just means you do not pay taxes on the capital gains or dividends while the money stays inside the account. The taxes are only paid when you eventually withdraw those funds in retirement. Furthermore, the contributions you make during the year might also be fully deductible from your taxable income in that very same year. Now notice the strict contribution limits we have for 2025. The standard contribution limit is $7,000 for those under age 50. For those 50 or older, an additional $1,000 catch-up contribution is allowed. That brings the total to $8,000. It is so vital to understand that these maximums apply to the combined total across all of your IRA accounts, meaning both traditional and Roth. You literally cannot contribute $7,000 to a traditional IRA and then another $7,000 to a Roth IRA in the same year. Your combined cap across the board is strictly $7,000, or $8,000 if you are 50 or older. Now, here is the absolute most crucial distinction you've got to grasp right off the bat. There is a huge difference between making a contribution to an IRA and actually being allowed to deduct that contribution on your tax return. Contributing to a traditional IRA is allowed for anyone with earned income. It does not matter how much money you make in a given year. However, actually deducting that contribution depends entirely on workplace retirement plan coverage. Basically, we're looking at whether you or your spouse has access to an employer-sponsored retirement plan. Think of things like a 401k, a 403b, or a traditional pension at your current job. So you might be wondering, how does the IRS actually know if you have this workplace coverage? Well, they determine your active coverage by looking directly at your W-2 form, specifically Box 13. When your employer issues your W-2, they are legally required to mark this little box if you are eligible to participate in their retirement plan. If that retirement plan box is checked, you are considered an active participant in the eyes of the IRS. And here is the kicker. You are considered covered for the entire year, even if you never contributed a single dollar of your own paycheck to that workplace plan. It's all about access. You really have to understand this Box 13 test completely before we even think about looking at income limits. Let's look at a concrete example so we can see how this rule functions. Meet John. John contributes $7,000 to his traditional IRA. His employer offers a 401k plan. Because of that, his W-2 Box 13 is checked. Because that box is checked, his traditional IRA deduction is no longer guaranteed. His deduction is now entirely subject to specific income limits. The practical takeaway here is simple. Always check your W-2 Box 13 first before assuming your traditional IRA contribution will automatically lower your tax bill. That brings us seamlessly into Section 2, 2025 deduction phase-out ranges based on AGI and filing status. So what exactly happens when that Box 13 is checked on your W-2? Well, your deduction doesn't necessarily disappear immediately. Instead, it phases out. It gradually reduces to zero within specific modified adjusted gross income, or MAGI ranges. Your MAGI is essentially just your gross income minus specific allowable deductions, and this is the magic figure that determines your final eligibility. Let's carefully walk through this table because everything here is based entirely on your filing status. For the single/head of household filing status, the phase-out range is between $79,000 and $89,000. Next, for married filing jointly, where the contributing spouse is covered by a plan, the range jumps up to $126,000 to $146,000. But pay close attention to the third row. For married filing jointly with a non-covered spouse who happens to be married to a covered spouse, there is a much higher phase-out range of $236,000 to $246,000. And finally, take a look at the incredibly strict married filing separately limit. The range is just $0 to $10,000. The IRS makes this limit extremely punitive on purpose. They do it to prevent married couples living apart from using separate returns to somehow skirt the workplace coverage rules. It basically means almost any income immediately wipes out the deduction. Let's bring in an example to see exactly how these ranges work in practice. Meet Sarah. Sarah is a single filer. She is actively covered by a 401k at work. Her MAGI for 2025 is $95,000. Because her specific income is fully above the $89,000 upper limit for single filers, her allowable deduction is completely eliminated. She gets exactly $0 in deductions for her contribution. The vital takeaway here is to monitor your MAGI closely throughout the entire year, especially if you know you're hovering right near these strict thresholds. Let's keep moving and look at Section 3, calculating your partial deduction when you fall right in the middle. When your income falls exactly inside the phase-out range, the deduction is reduced proportionally. The conceptual math to figure this out is actually quite straightforward. You simply take the distance from the bottom of your phase-out range to your actual MAGI. You then divide that distance by the total width of the phase-out range. That resulting percentage is exactly how much of your deduction is phased out. Let's look at the inputs for a real example to illustrate this perfectly. This is Rachel. She is 35 years old. She is covered by a 401k work plan. Her 2025 MAGI is $84,000. Her applicable phase-out range is $79,000 to $89,000. The bottom limit of her range is $79,000. The total width of her range is $10,000. Now let's take these exact inputs and apply them to our formula. We are going to build Rachel's math step by step. Her MAGI is $84,000. The bottom limit is $79,000. $84,000 minus $79,000 equals $5,000 above the bottom limit. The width of her range is $10,000. $5,000 divided by $10,000 equals 50% phased out. She contributed the maximum $7,000. 50% of $7,000 equals $3,500. Her final allowable deduction is exactly $3,500. So the absolutely crucial question is, what happens to the rest of the money she contributed? Rachel's remaining $3,500 is classified as a non-deductible contribution. It still goes into the account. It still grows tax-deferred, but it must be meticulously recorded on your tax return. A special IRS document called Form 8606 is used specifically to track this non-deductible basis. The vital takeaway for you here is that filing Form 8606 is mandatory. If you skip this, you could easily end up being taxed twice on this exact same money when you eventually withdraw it in retirement. No one wants that. Now, let's completely shift gears with Section 4, when income does not matter. This is the scenario with no workplace plans. This is a scenario that genuinely surprises a lot of taxpayers when they first learn about it. It completely breaks the mold. If neither you nor your spouse is an active participant in any workplace retirement plan, the strict income phase-out rules we just discussed completely vanish. Literally, there is absolutely no phase-out and there is no income ceiling restricting your deduction. Let's set up an example with a massive income number to demonstrate just how powerful this is. Meet Marcus and his wife. They are both self-employed. They have no workplace plans available to them whatsoever. Their combined household MAGI is an impressive $250,000. Marcus contributed $7,000 to his traditional IRA for the year. Because there is absolutely no workplace plan in the picture for either spouse, the phase-out rules simply do not apply to him at all. His allowable deduction is the full $7,000. This remains true despite his $250,000 income sitting well above every single phase-out threshold we discussed earlier. The massive practical takeaway here, especially for small business owners and self-employed individuals, is that without a workplace plan, your income level is entirely irrelevant to your traditional IRA deduction. Let's move into Section 5, the spousal coverage situation, where we often see two very different outcomes. This is arguably the most complex and nuanced scenario in the tax code regarding IRAs. Before we look at the numbers, let's understand the concept. This specific rule applies to a married couple filing jointly where only one spouse is actively covered by a workplace retirement plan while the other spouse is not. The tax code essentially treats them completely differently based on their personal coverage status. Let's look at Diana and Paul to see this in action. They filed jointly. They have a combined MAGI of $240,000. Diana is covered by a 401k at work.
Her specific phase-out range as a covered spouse is $126,000 to $146,000. Because their $240,000 combined income is way over that limit, Diana's allowable deduction is zero. Now let's look at Paul. Paul is a freelance writer with no workplace plan. His special non-covered spousal phase-out limit is $236,000 to $246,000. His MAGI is $240,000. The bottom of his limit is $236,000. $240,000 minus $236,000 is $4,000. The total width of his range is $10,000. $4,000 divided by $10,000 is 40% phased out. This means 60% of his contribution is still deductible. He contributed $7,000. 60% of $7,000 is $4,200. Paul's allowable deduction is $4,200. I want you to really think about that. Same household, same income, two completely different outcomes. It's incredible how the rules work here.
Let's wrap things up with Section 6, Important IRA Contribution Deadlines, and the crucial timing rules you need to know. This section right here trips up taxpayers every single year, specifically regarding when the money actually has to be deposited into the IRA to legally count for the given tax year. Let's look at the timeline. The absolute deadline to contribute to a traditional IRA for tax year 2025 is April 15th, 2026. This is the standard, unextended tax filing deadline. The absolutely crucial takeaway here is that filing a tax extension to October 15th does absolutely nothing to extend the April 15th IRA contribution deadline. Let me say that again. Waiting until October to deposit the money means your contribution will simply not count for 2025. It is a very costly and entirely avoidable mistake. Do not let that happen to you. Before we finish up, it is also highly important to note a major change that was brought about by the Secure Act of 2019. Previously, you aged out of being able to do this. Now there are no longer any age limits restricting traditional IRA contributions. Let's look at an example. Meet 75-year-old Thomas. Thomas still works part-time. Thanks to the Secure Act 2019 repeal of the maximum age limit, as long as Thomas has earned income, he can still legally contribute and potentially take a deductible contribution at any age. Let's do a really quick recap of the crucial steps we covered in today's explainer. Step 1 is always check your W-2 box 13. This is the absolute starting point to determine your workplace plan coverage. Step 2, if you are covered, you must check the specific phase-out ranges for your filing status and MAGI. Step 3, if neither you nor your spouse is covered by a workplace plan, remember that your high income level simply doesn't matter for the deduction. And finally, Step 4, always meticulously use Form 8606 to track any non-deductible basis so you can completely avoid double taxation down the line. Which leaves us with this final, provocative thought. Are you accidentally leaving tax deductions on the table because of a misunderstood W-2 box or a complex spousal rule? Don't let a lack of structured knowledge cost you your hard-earned money. This is video 2 of the 9-part miniseries on above-the-line deductions. Please make sure to subscribe to US Tax Classroom, and definitely don't forget to check our shorts for regular quiz questions to test your knowledge. See you in the next one.